Hi, Suzy Rhoades with PassMasters here for another Questions of the Week. This week, if you're studying for the SIE exam, this video is for you. We're going to cover questions related to Section 3 of the exam. Let me show you FINRA's content outline. As you can see, FINRA's content outline tells you that Section 3 is understanding trading, customer accounts, and prohibited activities. So they want to make sure you know all of the wrong things so you don't do them. It is 31% of the 75 questions that you can expect on your exam, a total of 23 questions related to Section 3. We will take a section exam from within our PassMasters SIE course. Let's check it out. In community property states, property acquired during marriage is considered separate property, considered individually owned, subject to estate tax, or considered joint property. You're going to choose which you believe is the correct answer. Consider joint property. Click check answer. You know you got it right if you get that green check mark. You can click show explanation and you can read the rationale, and you can also,
in community property states, property.
Listen. All of our questions have audio explanations for my auditory learners. An accountant makes a referral to a broker-dealer. When can the broker-dealer share commissions with the accountant? If the accountant is also registered as an agent for the broker-dealer or for one in direct or indirect common control. I like that. Always read all four choices first. If the accountant is an agent, that's not wrong, but the first choice was more correct. When the accountant owns her own firm, or never. Always pick the most correct answer. So if you ever have two answers, both are good, pick the most correct answer. I once had a student say, Suzy, the longest answer wasn't always right. Yes, I know that. I never said that. It's just, there was two choices that were both good, but you wanted to pick the best answer. It's too long to be wrong, they say sometimes. And if you have no idea, I would always say, guess the longest answer, but only if you have no idea. Which of the following parties would be in violation of the rules against insider trading? A person who trades based upon material non-public information, a person who hears inside information while in the sauna at the gym, a person who trades on publicly available information, or an agent who hears inside information and tells it to his boss. Well, that's what you should do if you're an agent and someone tells you inside information, tell it to your boss, your principal, so that they can put safeguards around it. So the only one that would be in violation of the rules against insider trading, a person who trades based upon material non-public information. Of those four choices, that was the best answer. All are laws or regulations designed to target money laundering except. So which one is not designed to target money laundering? The USA Patriot Act, Regulation D, the Bank Secrecy Act, or the Customer Identification Program. Regulation D is the federal private placement rule. It has nothing to do with targeting money laundering, but the USA Patriot Act, the Bank Secrecy Act, and the Customer Identification Program, all three of those programs do have to do with targeting money laundering. Buying a bond on margin must be done in a mixed account, discretionary account, cash account, or margin account. Buying a bond on margin means you're buying it with borrowed money, and that can only be done in a margin account. An S corporation is limited to how many shareholders? 200, 10, 100, or 75. An S corporation is limited to 100 shareholders. Under FINRA Rule 4370, broker-dealers must have procedures and processes in place to ensure that critical business functions can continue during and after a disaster. What is this called? Disaster recovery, business continuity plan, succession plan, or FEMA documents. This is called a business continuity plan. We have to be prepared for worst case scenarios. A block order involves how many shares of stock? 1,000 or more, 10,000 or more, 100,000 or more, or 50,000 or more. A block of stock is 10,000 or more shares. Which of the following is not considered an institutional client? Bank, individual participant of a qualified plan, investment advisor, or member firm. So which is not an institutional client? An individual is not an institution. So a bank is an institution, investment advisor, member firm, those are all institutional clients. But individuals, we call them retail clients. The Bank Secrecy Act requires that every financial institution file currency transaction reports for each cash transaction that are less than 10,000, exceeds 10,000, seem suspicious, or are wire transfers. Currency transaction reports are required for each cash transaction that exceeds $10,000. The investment's quarterly return was 3%. What is the annualized return? Well, how many quarters are there in a year? 4. 4 times 3 is 12%. Annualized return. The best rate of return for comparison purposes is an annualized return. A stock buyback is also known as a stock split, tender offer, warrant, or rights offering. A stock buyback is also known as a tender offer. Proxy solicitations must disclose all important facts about the issues on which shareholders are asked to vote. I like that. Be approved prior to mailing by the SEC. Do they ever approve anything? No way. Be forwarded by broker-dealers to clients within 30 days of receipt, or be filed with FINRA within 45 days of mailing. Proxy solicitations must disclose all important facts about the issues on which shareholders are asked to vote. When making a recommendation to a retail client as to type of account, Regulation Best Interest applies only if it is a fee-based account, does not apply, applies only when the client is age 65 or older, or applies. When making a recommendation to any client as to type of account, Regulation Best Interest applies. All are true about the bid and ask prices except. So which one is false? The dealer sells at the bid. The dealer sells at the ask. The client sells at the bid. The client buys at the ask. All right. So my brain gets all jumbly on these kinds of questions. So this is how I handle it. I know that the client buys at the ask and sells at the bid. That's really intuitive. Students always get that. That's simple. So the client buys at the ask is true. The client sells at the bid is true. And then the other two choices that are left, they contradict each other anyway. So this is how I recommend you do it. The client buys at the ask, true. The dealer does the opposite, sells at the ask. That would be true. The client sells at the bid, that is true. The dealer buys at the bid would be true. So we're looking for the false statement. The dealer sells at the bid, that is false. It's right because it is not true. You can do it. When a member firm is new to the industry, they must file all communications with FINRA for the first year, Must file retail communications within 10 business days of first use with FINRA. Must file retail communications with FINRA at least 10 business days prior to first use, or are subject to a lower level of scrutiny than established firms. Well, that's definitely false. They're subject to a higher level of scrutiny during the first year. They don't have to file all communications, however. They have to file retail communications with FINRA at least 10 business days prior to first use during their first year of business. Under Regulation S-P, consumers must be given a reasonable means to exercise an opt-out right. Which of the following is not a reasonable means? Provide a toll-free telephone number to opt out? Seems reasonable. Provide electronic means to opt out? Seems reasonable. Require the customer to write a letter to opt out? Write a letter? When's the last time you wrote a letter? That does not seem reasonable. Include a reply form together with the opt-out notice. That would be reasonable. So which one is not a reasonable means? Require the customer to write a letter. You should write letters. It's nice to get mail, but none of us do. Maybe you do. Probably not. Which type of business does not survive the death of the owner? S corporation, C corporation, LLC, or sole proprietorship. It is the sole proprietorship that does not survive the death of the owner. In a cash account, an investor who tries to sell the shares before having paid for them may be found guilty of marking the close, free riding, marking the open, or churning. It's called free riding when you try to sell shares before you've paid for them. It is prohibited, of course. All are true regarding IRAs, except what is false regarding IRAs. Traditional IRA contributions are always tax deductible. That seems false to me, but let's check the rest out. Roth IRAs are funded with after-tax dollars. That's true. Roth IRA contributions are never tax deductible. That's true. Roth IRA distributions do not have to begin at any specific age. That is true. So the false statement, traditional IRA contributions are always tax deductible. It's right because it's wrong. Feels weird, but you'll get used to it. Practice. Mitch just recently joined the firm as a registered representative. He has a personal trading account at another member firm. Which of the following is true? He must close that account. He must give written notice to the firm carrying the account of his relationship with his employing firm. He must notify his boss that he has the account. Or the firm carrying the account must provide his employing firm with duplicate confirmations. So only one of those statements is true. He must give written notice to the firm carrying the account of his relationship with his employing firm. It is true that his employing firm has the right to request duplicate confirmations, but they are not automatically sent. Which type of tax rate is harder on low-income families? Income, estate, regressive, or progressive? It is a regressive tax rate that is harder on low-income families. Something like a sales tax rate is the same no matter what your income level is. So as a percentage of income, sales taxes paid will be higher when somebody has a lower income versus a higher income. Higher as a percentage of their income. So regressive tax rates hurt low-income families more. Market breadth indicators are seldom used, technical only, fundamental only, or fundamental and technical. Market breadth indicators are technical only. Market breadth indicators analyze the number of stocks advancing relative to those that are declining in a given index or on a stock exchange. They are technical only. Breadth indicators are oftentimes used to give investors an overall view of the market. Great job! We did it 100%. I hope you learned something for your SIE exam. If so, be sure to give this video a thumbs up, subscribe to our channel, and turn your notifications on. If you have any questions about this content, just ask me in the comments below. If you'd like to check out PassMasters course offerings or to enroll in any of our programs, there is a link found in this video's description. Thank you so much for watching. I hope to have you as a student soon. Happy studies! You got this.